Hello traders, my name is Christopher Mullen. I'm the founder of thetechnicaltraders.com, and I just want to do a short video explaining how to read intraday price action, know when the key pivot points are, when to trade, when not to trade, and how to really spot and time your entry points in the market. Now if we just take a look at a clock here, you can see this is it's colored in. This red zone here from 9:30 to 9:45 is generally when you see a massive surge of volume in the market. That's when people who have placed orders in overnight trading or pre-market get triggered, so there'll be a lot of orders going off. The market usually chops around in a very wide range, very unpredictable time to trade. After about 15 minutes, the market, you'll notice when the volume will settle down, and from 9:45 generally to around 11:30 is when you have a nice trending market and a high probability of catching and pulling money out of the market. Now during the lunch hour from 11:30 to 12, volume starts to dry up, and pretty much consider 11:30 till about 2:30 is about the lunch hour. It's light volume. The market makers will chop the market around. They're going to make it very difficult to hold your positions. So usually when you see a morning trend, say for example you see a morning trend up to 11:30, once 11:30 hits, most traders will pull their positions off, and you'll see a counter trend trade through the afternoon. So up in the morning and fade back down or sideways during lunch, and then you'll see usually a continuation of the morning trend in the afternoon. It starts usually around 2:30 and it'll push all the way into the closing bell. Now again, at the last 15 minutes of the trading session, you can get very strong whipsaws in the market, very strong surges, and you've got to be cautious. Trading does become higher risk, and while it can move very sharply in your favor, you got to be cautious and manage positions, because it can also have a quick hook at the end of the day going against the trend. Now if we take a look at some intraday charts, this is a 3-minute candlestick chart, and this is from 9:30 in the morning till 4 o'clock in the afternoon. So this is a full trading session. Now you can see here I've got the clock 9:30 to 9:45. This red zone, you can see there's a red zone here on the edge. Of course, it's a volatile time of the morning, and really you'd want to try and avoid those times until a trend starts to take place. Once a trend starts, you can see you get a nice continued move, usually to around the 11:30 point is when the market usually tops or bottoms out for the session. After that, you get afternoon chop, sideways action, and there's no need to really be in there, because the market makers will try and pull the money out of your bank account and give back any gains you made in the morning trends. Once 2:30 hits, usually you'll see volume slowly start to pick up, and the morning trend will usually continue into the close. Now afternoon trends usually aren't as strong as the morning. Morning has got all the volume, it's got all the focus. A lot of people give up, stop trading more or less around lunch, and they may dabble in the afternoon, but overall volume is usually lighter in the afternoon, and the trend continuation is much smaller. Now taking a look at a downtrending market, you'll see the trend move down in the morning, usually bottom out around 11:30, and then you can see it trade sideways through the lunch hour. Eventually, usually you'll see a continuation in that trend going into the close, and during the last 15 minutes you can see extreme high volume step in, and while price moves sharply in your favor, it can give it back in a blink of an eye, some of it with a sharp either short covering rally or what have you. Now taking a look at just another recent example here, this is Apple just yesterday or a couple days ago. You can see here we've got a downtrend in the morning, more or less till around 11:30, around 11:36, more or less the morning trend down. It's a little choppier. It is a stock, not an index, so it can be a little bit choppier, but overall downtrend in the morning till around 11:30, and then we had sideways kind of counter trend fade back up during lunch, and then around 2 o'clock you can see volume start to step back in, and we saw a continuation squeeze lower. Now if we take a quick look at another chart here, you can see this is a regular trading session in between these blue lines here. This is the 9:45 session, this is to 11:30, afternoon doldrums, and then you've got your end of day push and volatility. Now if you do use some market sentiment and volume and trends and things like that, you're able to find extremes from previous days and more or less hold off for the momentum to stall out going forward. You can see here I have created an algorithm that can actually pick up on extreme oversold conditions, giving you an early signal, actually the previous session, and you can actually see how you catch the entire trend from one swing to another, and the following session you actually see when the market becomes exhausted and overbought. Now these type of plays generally last 1 to 3 days. Is more of a momentum, not so much of a day trade, but once you get these buy signals, you can generally day trade the following day knowing with confidence that the trend should move higher in your favor. So once you do get a setup and a breakout in the morning, you've probably got a pretty strong trend in the morning up to 11:30 to pull some more money out, and again in the afternoon you're likely to see another squeeze higher if you want to be more aggressive with extra positions during the day. Now looking at another chart here, if we just go to the daily, this is the SP 500 index, the SPY ETF. You can see I've created more or less a system that shows you when it's trending, when things start to reverse, when you start to go into a downtrend. So more or less what it is simply clarifying what trend the market is in. More or less when the candles are green and you get a green arrow, you're generally adding to a position or getting long. On a dollar sign, you are pulling some money off the table, adjusting your stops. So you've got multiple entries, multiple profit targets being reached, and simply all it is oversold, overbought market conditions, and you're constantly trimming, adding and trimming in a trend. And same goes for a downtrend. Now when the candles are green, you're looking to more or less look for long positions in stocks, various ETFs, and for sectors and commodities. When it is orange, you're looking to pretty much sit on your hands, maybe even reduce your position size in any positions you have, simply because it is an early sign that the market could be reversing, so you want to minimize your risk. Once the trend changes, you're looking for shorting to short, more or less shorting on the red arrows, taking profits on extreme oversold conditions and adjusting your stops. And of course, when the market is trending down, you don't really want to be long the market. You're looking to be long inverse ETFs or short the market using various sectors and stocks. Anyways, that's it for this video. Hopefully this you find helpful for intraday price action and understanding what the trends are. Thanks very much. Bye-bye.